Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. I am joined here by one of my associates, Nick DeVito, also a CFP, and more importantly, our guest today is Adam Hunt, also a CFP, and owner and founder and CEO of EZTPA.
Correct.
You know what? It just gets me. I apologize for that.
No worries.
So Adam is a third-party administrator, which is a TPA, which is a key role in 401k plans. So Adam, what I'd like you to do is take a moment and tell me a little bit about yourself and your company.
Yeah, absolutely. Thank you for the time today. I appreciate being on your podcast.
Of course.
So I founded the company at the start of COVID in 2020. The idea of a TPA is we are pension specialists on 401k plans, helping small businesses comply with the myriad of IRS rules and regulations that exist in the marketplace.
Okay.
So it's definitely an area that's growing with the growth of 401ks that we're seeing across the United States. So I found that from my perspective, it's been a really interesting journey over the last 6 years, from starting out where we're brand new to right now we have almost 600 corporate clients that we serve across the United States.
Wow. So how would you differentiate yourself from some of the other TPAs that are out there?
Yeah, so when I built the company, the idea was that we wanted to be a client-centric experience, right? And I grew up wholesaling to small and medium-sized businesses. But I spent the latter half of my wholesaling career doing institutional sales, so working on large enterprises. And so the idea was to bring the best practices of that institutional space to small and mid-sized businesses, because the needs are identical. If you're Google, you can afford a dozen of me. But if you're a small business owner, you need expertise, very expensive just to hire me. So the idea was to bring that best practices down. And that's how, only through organic growth and really word of mouth, that we've grown to 600 plus clients in 6 years. Yeah, it's great.
So what most people don't realize is that there's a TPA behind every 401k. Yeah. And it just so happens that some of the large ones have a TPA bundled in. So large plans may be like, say, the Vanguard or a Fidelity or an Empower. But if it's a giant plan, they probably have a TPA built in. But we use Adam all the time for smaller plans where we separate the two, and Adam serves in that role. But tell me about the different roles in a 401k plan. You got multiple people.
Yeah, absolutely. So if you think about the client, right, that you own Menninger and Associates, right? So let's just make you the client in this illustration, right? So you're in the center of a box, and then there's four parties of interest in that box, right? So the first one, let's just pick the top left corner, is the financial advisory group, right? So let's just pretend you're serving as your own financial advisor, right? So you're talking with the employees, you're giving investment guidance, you're helping the client work with building the portfolio overall. You're the central quarterback to that relationship. You're the nexus, right? Because we, as a third-party administrator, we do not distribute directly. We work only through financial advisors like yourself, because we want that collaborative relationship, right, with you and with the client. Then in the next corner, you have the third-party administrator, right? And so our role is what we define as compliance work, right? And this is, if you think about an iceberg, you've got 90% below the water. We're basically everything below the water, right, when it comes to the plan. So we're taking care of the government filings. We're doing the legal plan documents. We're working with you and maybe the client's CPA on tax efficiency for the plan, because there's a lot of great ways that you can design these plans to reduce your income tax liability, which I know we'll eventually get into. We're there to answer any questions, problems, concerns, right? Because 401ks, people make mistakes. Oh, I messed up my payroll. What do I do, right? So that's kind of our role, is to serve as kind of that back-end quarterback to make sure everything kind of operates together. Then in kind of the bottom right corner, let's just say you have your record keeper. So this could be a Fidelity, this could be a Vanguard, this could be a John Hancock, right? And their role is to provide the websites, they're going to provide the call centers, they're going to do the statements, they're going to make sure all the money is properly allocated. So when I log into my John Hancock account, I go, great, there's my money, and it's broken up and I can see everything in real time, right? And so they're, we could also call them a custodian, right? Kind of that idea. And then in the bottom left corner, which is also really important, is your payroll, right? So whether you're working with ADP or Paychex or a local payroll company, right? The key piece is creating that handshake between the payroll company and the record keeper, right? So all of the major 401k players in the United States will have handshake technology with the payroll vendor, right? And that's really critically important because you want to be able, as a business owner, when you run your payroll, to go, great, Mike's putting in $100, Adam's putting in $100, right? That all goes over timely, right, and automated. But the really nice piece with those kind of handshakes is at the end of the year when you have to do the pesky testing and we're going to ask you for all the census data, the company that does that handshake actually creates all that for you, right? So we use a company called Payroll Integrations. We found them to be great, but there's other vendors that are out there doing the same kind of things. But those four pieces, when you put them all together, if they're all talking to each other, they're all working seamlessly, the client experience is flawless. Like the client's going to have a great experience. They're not going to have any questions, problems, concerns. And if there's a mistake, they're so easy to fix. It just takes moments, right? I can't tell you how many times that when we're talking to new prospective clients, we're uncovering all sorts of interesting, we didn't do this or we didn't know about that. And then it's like, well, how would you like to correct that? Let me tell you what the cost of correcting is. Like I just had a client yesterday that's coming on board to us. We went through, they haven't been in compliance since 2022. And they said, well, what's the bill? And I said, well, you're looking at about $150,000 mistake right now, not including penalties to the IRS. They're like, but we only have 15 people. I said, yeah, but it was a lot of people where money was not properly handled correctly, and there's a lot of penalties.
Right.
And they're like, okay, so having those component pieces and everybody talking, making sure that it's being taken care of is what really matters, because no one wants to get that bill.
Of course. Now, well, just with anything, the more you're on top of it, the less likely it's you're going to have a big thing blow up. And I know the role that you play, at least from our perspective, whether it's me as the company owner or me as the advisor, we're really leaning on you heavily in February, March, and April.
Yes.
Because that's when you're auditing the plan.
Yes.
You're making sure that all contributions were made, all matches were made.
Yes.
And did anybody over contribute, and meeting all of the criteria that are regulatorily required.
Correct. Yeah. So we're from really January 15th to March 15th is your big deadline, right? Because everyone's crunching for tax season. And the IRS has very specific timings on March 15th and April 15th, and you have to meet these deadlines. What makes it even more difficult is the record keepers need time to process. So if there's something that needs to be corrected, you're not really working with a March 15 deadline. You're working with like a March 1st deadline.
Right.
6th deadline, right? So the more that we can make it where the systems are automated talking to each other, and the more that we can get from technology, right, to drive like, hey, I need this information, the easier it is. The other piece that also comes in, right, is with the plan design and then collaborating with the CPA, because people want to have a tax efficient plan. If I'm a business owner, I can put away, $80,000, $70,000, right, into these kind of plans. How much do I have to give my employees? Do I want to make those contributions, right? Those are important discussions, and you have to have all those done basically before March 15th.
Right. And so
it's a lot of work.
And I know too, and I've had these discussions on behalf of clients as well as for our plan. That's when we're approaching the TPA, who's doing all of the behind the scenes calculations as to how much can I contribute and what are the different costs associated with providing my employees with additional profit sharing, et cetera.
Yeah, absolutely. Yeah. So, we can talk, like there was the one opportunity that we talked about where the client has, he's a younger guy, makes some good money, had an older HCE, highly compensated employee. And when we kind of reconfigure things, all of a sudden the numbers look really great, right? So part of what we do is working with you is going, okay, what's the goal of this business owner? Okay, the business owner goes, look, I just want to offer a retirement benefit, right? I need to check that box in order to recruit and retain employees, right? That's usually the first piece. But the second piece that goes deeper into it is, well, you offer this great benefit. Do you want to try and take advantage of it as the business owner to maximize your contributions today, which reduces your income tax liability and your tax sheltering money for extended periods of time, right? And then that conversation goes, great, well, how much do I have to give my employees in order to benefit myself? So let's just make it a very simple example. Hey, I want to put away $70,000 for myself. Well, we can calculate the number and say, hey, it's going to cost you $10,000, right, to do that. You got to give 10,000 employees to put away 70. Well, the simple math of that is, would you rather take $80,000 and pay tax on it entirely, or would you rather give $10,000 to your employees versus the government and then have
Right.
$70,000 in your own pocket, right?
Of course.
And that is a really powerful conversation because now people start to go, great, how do I take advantage of the plan for myself, benefit my employees, and recruit and retain key employees?
Correct.
And you can use retirement plans for all those functions.
Absolutely. And I'm glad you brought that up, because what we're planning on doing here is we're going to make 2 episodes out of this. What we're planning on doing here is talk about some of the fundamentals of the 401k plans, the role of the TPA, and some of the nuances that came out as a result of Secure 2.0, which was the second, was it 2022 that came out?
Yes, that's correct.
So we'll be talking a little bit about that in the beginning, but the second episode, we're going to talk and get deeper into what I refer to as advanced 401k design, which is one of the things that I know you bring a tremendous amount of value in.
Yeah, absolutely. We specialize really in helping small business owners maximize tax deductions. Now, that isn't to say that we don't have large clients. We have clients with thousands of employees, and we 100% look to help them. But they're going to operate differently in terms of what their goals are versus a small business owner, right? And so we find that where we can bring the most value to our clients is small business owners that are looking to really tax shelter large amounts of money, and ideally probably catch up, right? It's not uncommon that your power money earning years are really kind of that 45 to 60 age, right? And you're as you're going through life, hey, I'm in my 30s, I'm making good money, but I got kids, right? Maybe you decide to buy a second house, maybe unfortunately you get divorced. There's all sorts of things that go on. So it's not uncommon that we're talking to a business owner that does very well financially but has no retirement saved at all. And the question is, well, how do I accelerate to get back? Because I've only got maybe 10 or 12 years before I'm looking to retire, right? So those are important pieces too.
Does that design that you referenced need to be done when the plan is created, or can it be adjusted and modified after the plan's been created?
So it just depends on what we're trying to do and how your business is structured. But generally speaking, you just need to have the 401k established in the current calendar year that you're trying to make a benefit for. So for example, if I was trying to do something for 2025, I'd want to have at least the 401k set up in 2025. But again, it also depends on the nature of the business and how they're structured. And we can talk about if you're an S Corp versus a sole proprietorship versus a partnership versus a C Corp. Those designations also impact the design, the way that you're receiving income, right? These are all functional pieces of kind of that discussion about what we do. But ideally, what we want to make sure is that that you have a plan set up in the current year, so let's say 2025, and then it's also a question of, and I know we'll go in this later on, is am I doing a traditional 401k or am I doing a safe harbor 401k? Right. Those kind of component pieces, and we can talk about what that means. And then the best way to think about 401ks as we're building them is we've got the 401k in the bottom, kind of like a pyramid, like the old food pyramid that we used to see, right? The middle is kind of your profit sharing, which we can talk about, and then on the top is, and I know we'll get into advanced plan design, is cash balance plans,
right? And
how those layer on top and what those all look like.
Well, I think what you find with a lot of business owners, particularly smaller business owners, is they're a lot different today than they may have been 5 years ago when they established a plan. So the question is that if they established the basic 401k 5 years ago, do they have the ability to add all of these advanced design features later?
We can always add them in the current year. Yep, okay. Absolutely. And more interestingly, there are certain features. So for example, we can add a cash balance retroactively. So cash balance, we could sit there and go in 2026, do we want to add that retroactively for 2025? Profit sharing, you had a component, is it the right component? Maybe we have to set up a second profit sharing plan, but we can do any type of employer funded piece, right? Can be set up retroactively. The one piece that really can't be set up is the 401k piece, because that's considered a deferral, right? That's coming out of your W-2 pay,
right?
Or if you're a partner, it's coming out of your K-1. So generally that needs to be set up in the current year, but there's exceptions to those rules. But ideally, the bigger pieces, we can always add those on later on, and we can generally amend the plans also after the end of the year if we need to, depending on just how they're written. So the way that you write your document is extraordinarily important, right? If you don't write it the right way, you eliminate any flexibility. And so part of what we specialize is drafting those documents so that when a client says, I want to pivot or I want to make a change, we've got as much latitude as we can legally give them under the IRS rules.
But what I'm asking is that if the plan was already written, the summary plan description was written 3, 4, 5 years ago, you can rewrite it.
Always can rewrite it. Yeah, you're only ever stuck in it for at most 1 year.
Right.
And in many instances, we can rewrite it in the current year.
Perfect.
Yep, absolutely.
So, tell you what, we're at a good breaking point. Stay tuned. We'll be back with you in just a few moments, at which point we're going to talk a little bit about the state mandates, what happened with Secure 2.0, and some of the regulatory tweaking that has occurred in the last few years. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger and Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained as we continue with Adam Hunt, who's a CFP and a TPA, alphabet soup here, right?
Absolutely.
So we're talking about the 401k plans, and we're going to pick up where we left off and talk a little bit more about state mandates that you referenced, as well as Secure 2.0, which really honed in on Secure is an acronym for, I don't care what it stands for, but it made a lot of changes to the retirement plan. So maybe you could pick up and talk about that.
Yeah, absolutely. So there was two versions of Secure Act 1.0 and Secure Act 2.0, right? And the idea behind these was there was all sorts of things in that legislation, but retirement related specifically, the idea behind it was to improve the efficiencies of plans, to get rid of certain rules that were just kind of antiquated, right? They were just overdue to be kind of pulled back with the changes in technology and just, the American public. But it also was designed to create ways of encouraging businesses to start new plans, right? So if you look at the demographics across the United States, 95% of the American public works for small businesses, right? And those small businesses, meaning anyone that employs 50 people or less, like that's kind of the definition. And the challenge is in that very large demographic, only 50% of small businesses offer any type of retirement plan.
Did not know that.
Yeah. And so that's also kind of what led to this idea of like state mandates, right? Where states are now going out and saying, we are going to require you as a condition of being an employer in our state to offer a retirement plan to your employees, or you have to adopt the state plan. And the state plan is basically a supercharged IRA.
Right.
So there's not a lot of great advantages for the business owner to adopt those versus going to the 401k. And so as a kind of an offset to this state mandate in Secure Act 2.0, they created these tax credits, right? And the tax credits are designed to offset the cost for several years that the employer would incur, and then also to encourage giving contributions to the employees, right? So when we look at the state mandates, so like for example, we're here in Pennsylvania. Pennsylvania currently does not have a state mandate, but it is, in Harrisburg, it's under consideration, right? 28 states are looking at adding it. 20 states have it today. So for example, if you're in New York State and you have 10 employees or more, you're required to offer a retirement plan. But if you're based out of New York City, it's 5. If you're in New Jersey and you have 25 employees or more, you're required to have it. If you're in Maryland, you only have 1 employee, you're required to offer a retirement plan, right? So each of these states has kind of these different requirements and rules. So, and then if you're not in a state that doesn't have the mandate, you still get the advantage of the tax credit. So the way the tax credits operate is there's 2 of them. There is what we call the administrative tax credit, right? And that administrative tax credit is up to $5,000 a year for 3 consecutive years, okay? And you get $250 for every employee that you have making under $100,000, and you get $500 right off the bat. So if you just had 1 employee, you get $500. You have 2 employees, you get $500. You also get a $500 tax credit for automatic enrollment. And I'll go into that a little bit because plans that are starting today have to have automatic enrollment if you have 10 employees or more. Or if you've been in business for 2 years or more. So if I start a business today and I have 25 people right off the bat, I'm not required to have automatic enrollment. But in 2 years, I am. And so what we usually tell our clients is just add it now. It's not so bad. Because right now, the way that 401ks operate, if you're a legacy plan, this is anything where you're prior to, I'll make it simple, 2023. This started 2023. So if you had a plan before 2023, you have what they call the opt-in. So I come work for Mike Menninger. Adam, you're now eligible for the plan. I have to say, great, I want to be in your plan, and here's how much I want to put in. With automatic enrollment, it's the other way around. You're going to come and say, hey, Adam, you're in the plan, and we're automatically putting you in at 3% unless you opt out, right? So that's going back to that original conversation we had about the integration with payroll and the record keeper. This is where that really matters, because if I want to opt out and we have that integration, guess what? I can just go right on to John Hancock's website and say, I'm out. And let's say you're using, Gusto for your payroll. It'll automatically go right back to Gusto, and I'm opt out, and the business doesn't have to do anything,
Right.
which is great, really clean.
And I get the credit anyway. As the business owner, why not do it? I mean,
Right.
number one, I'm encouraging by forcefully encouraging, but they have the choice to opt out. So it's really no skin off my
And I
back.
think that's where the advisor really comes in and plays that educational role to help relay that from the TPA or from the record keeper to the actual participants, because the business owner knows the nitty-gritties of the plan. They're the one working with the TPA to really help design it. It's the rank and file employees that our job really as the advisors is to educate them so they know what their options are. They're not spooked by the auto enrollment because we're explaining to them, look, this is in there just so you know you can opt out, and here's how.
Yep, absolutely. And I'll talk a little bit about, as we get through this, is just there are some new tax credits that go into effect starting in 2026 for rank and file employees where their compensation isn't, $150,000, right? So there's some tax credits there that I can get into. So just wrapping up on the employer tax credit, so you have this startup tax credit for 3 years, right? Up to $5,000. So if you had 20 employees, you're getting a $5,000 tax credit. And a tax credit is obviously better than a deduction because you're just straight up offsetting a federal tax bill. So if at the end of the year, your CPA comes and says, hey, Michael, you owe $5,000 in taxes, you'd be like, well, actually, I set up a 401k plan. I had to pay Adam for his services. It was $5,000. Let's make the math easy here. I get a credit. You wipe out all your tax bill, which is great, right? So that's a home run. The other thing that was added, now that was under Secure Act 1.0. What was added under 2.0 is the employer tax credit. So the way it works over 5 years is for the first 2 years. So let's say you set up a plan in 25, so 25 and 26. For anybody that makes under $100,000, the first $1,000 you give them is now a tax credit.
Right.
It then drops to $750, $500, and $250, right, per person. So if we did a design and I said to you, hey, Michael, I'm going to be able to put away for you as the owner $70,000, but you got to give, you have 10 employees, and let's just say you got to give them $10,000. Guess what? That $10,000 is now a tax credit.
The entire amount is not capped at $5,000?
Nope.
So the $5,000 is capped only for the administrative portion, but it's $1,000 per employee.
Yep.
If you're matching.
If you give them the $1,000. If I give you $1,000, cool. Now, if I gave you $2,000, the first $1,000 is a tax credit. The other $1,000 is now tax deductible.
Sure, but that's a beautiful thing because effectively, at the end of the day, let's say I'm giving 3% to somebody who makes $50,000. That's $1,500 that I would have been giving them anyway. I'm getting $1,000 back.
Correct. 100%. So it's those tax credits we found have been very helpful in small businesses making the decision of now offering a plan, right? Because if you're sitting there and you're just a small business owner and you're running on, I'm a small business owner, right? Margins are always tight, right? Is someone walks in and goes, oh, well, it's $1,500 to set up a plan and it's $3,000 a year. You're like, I don't really need a plan unless the state's requiring it. Now it's like, well, that whole fee is covered for the next 3 years. Okay, let's do it. I mean, we can always reevaluate in 3 years. And honestly, by that time, you're going to find that because you have a retirement plan, your ability to recruit and retain people just goes up.
Sure.
Right. And we can talk about that in our next segment as well.
I think that is one of the benefits as an employee seeking a job. If a place doesn't have a 401k or retirement plan, that's going to be, I don't want to say a red flag, but that's going to be could be a deciding factor for you, because I think it's more expected nowadays
100%.
to hear that. That's the benefit I think people are most familiar with. Probably 401ks and health insurance are the two things people expect when they go to a company. So I think, to your point, having those credits available, encouraging them to do that. And I know for us, it's a great planning tool and a selling point for that planning tool, because we're always trying to maximize tax efficiency.
100%.
And a great way to do that is through a 401k or a retirement plan. And we now are able to do that for little to no cost to the client up front.
Absolutely. Yep. And then employees getting the benefit of now there's an incentive for the employer to want to give them that money, right? Because it's like either I give it to my employer or I give it to the government, right? Which one do I want to give it to? And then again, you can put, depending on how we design it, there might be vesting on those dollars, right? So hey, I gave you $1,000, I get a tax credit. Michael leaves, and the $1,000 I get 600 back, and he only gets to keep 400. Like we can put vesting schedules on these things. So there's all sorts of incentives to really take a deep dive, especially if you are a business owner that doesn't have a plan. Now, the only caveats to the tax credits that we should definitely talk about is if you had a plan already in existence.
Which was a question that I asked 6 different experts. We're moving from a simple plan to a 401k. Do they get the credit? And I will tell you it was a tie. 3 said yes, 3 said no.
Right.
You want to be the tiebreaker?
Tiebreaker is no. You do not get the tax credit. However,
Which tax credit?
Well, that's a good question. So it depends on when you started your simple. So if you started your simple in 2023, right, and then you go to a 401k, you're still eligible for the 401k in 2025 because it's 3 years. I had a plan. I'm still eligible for the tax credits. Now, if I had a plan in existence for more than 3 years, let's say I had a simple and I started it in 2020, and now I go to set up a 401k, I'm not eligible for it because I have a 3-year look back on the startup credits.
On the startup credits, and they have a 5-year on the credits to the employee?
Absolutely. So so for example, I started my business in 2020, right? And I started hiring employees starting in 2021 and 2022. And, we've got like almost 10 employees now. The tax credits, even though I started the 401k in 2020, I actually was able to get a $250 tax credit for 2024 for all my employees.
Right.
Because I had that 5-year window, right? So I didn't get any of the employer tax credits, the administrative tax credits, but then again, I also charged myself a fee, so, kind of washes itself out. But it is available. But no, generally speaking, if you have a plan in existence for more than 3 years and a simple or a SEP, and you go to set up a 401k, you're not going to be eligible for the administrative tax credits. But the matching credits.
So you're kind of, and I thank you, Adam, for this, as you explained it in a way that actually makes sense. It's effectively when they started a plan. Yeah. They lose the first however many years of the administrative credit. Mm-hmm. If they've had it for 2 years, then they get the 3rd year of the administrative credit, and the 4th and the 5th in the employee match credits.
You got it. Absolutely, 100%. So it's, and again, what's really nice is the way that they've changed the rules around going from a simple to a 401k, which I know we'll talk about as well. It used to be, I had a simple, I have to wait until the next calendar year to set up a simple. That rule has been done.
Right.
It's a really nice compromise, I think. So you can go, hey, I have a simple, I want to go to a 401k. What do I want to do? And you can go that route.
Perfect.
Yep.
So I'll tell you what, we're wrapped up with the first episode here. So here's what we're going to do. We're going to pick this up with the next episode. We're going to talk about some of the fundamentals of the 401k, what's your contribution limits, et cetera. And from there, what we'll do is we'll be able to pick up and talk about specific types of plan designs, new comparability plan, cash balance pension plan, and all the different tweaks that a business owner could do to supercharge, is the word you like to use.
Absolutely.
To supercharge a 401k that can be making it beneficial for the owner as well as the employees. So we'll be talking more about that in the next episode. So thank you very much for joining us, and we'll see you in the next episode. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there is an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.